Everybody's bought into the belief that the U.S. is heading into a recession. We see faltering economic stats. Everybody thinks / knows that Chinese demand is deplorable. Year-over-year growth this year is at a 15-year low when you exclude COVID. So demand is not living up to what we had hoped earlier on in this year. So there is merit to some of the poor sentiment. Yet at the same time, and I go out of my way on places like Twitter to put up graphs, global oil inventories today are at their lowest levels on record. And so despite all the bearishness, all the views and...
Which means what, in practical terms?
So the balance between supply and demand remains in deficit. Inventories continue to fall, even though demand is not living up to expectations. And so that, to me, is a very, very bullish stat, which validates our view that crude oil today is mispriced. We are at least $10 per barrel below what we estimate to be fair value when you measure inventories divided by demand. And we see that going forward. And so seeing the reaction today where every strength gets faded, the belief that China's weak and the US is going to be weak and the Fed eventually is going to be cutting all these different things, it's difficult to get past that bearish narrative. And I think right now we have to remind ourselves, we've been through this before. There are periods of time where you have to remember there are two markets for oil, the financial market and the physical market. The financial market for oil is 50 times bigger. And so this sounds like the worst excuse in the world, but CTAs, algos and such, when human beings, there's too much uncertainty and volatility to deploy risk capital, you are then at the whim right now of CTAs. And that's what I think is influencing the crazy volatility and the trajectory of the price over the past couple of weeks.
What about the idea that financial markets are forward-looking? So fine, global inventories are what they are now, but I'm looking 6 months out and I'm worried about demand in the future, because why are we getting all these rate cuts? It's because we're seeing a slowdown.
And that's fair. And so that's why it's important to reflect on why did we see members within the OPEC group, the fabulous 8 who are voluntarily curtailing production, why did they defer? I think what they're seeing is not necessarily price action, but the volatility that we have in price is very destructive to the ability of companies to grow production. We see U.S. shale companies, for example. U.S. shale production has been flat for the past 8 months. A firm we subscribe to called Rystad, it's globally renowned and respected, they're forecasting flat production for at least the next 9 months, and that's before the oil price collapsed. What that means is U.S. shale production on a year-over-year basis will be flat by November, in 2 months, roughly 2 months' time. You have OPEC plus members within that are trying to ease the volatility, and so what they're saying is market conditions don't allow us to have barrels pulled from us, and we're not going to push barrels onto the market. So that validates our view. And someone like Mike Rothman, he's been on this network many times. He's been doing this for 40 years. And he says, look, OPEC is not going to push barrels onto the market. They're going to wait for market conditions to be allowed for those barrels to be pulled from them. We're not there today.
And often we don't actually see the results of OPEC decisions even like a week out, right? I've go back like over a year. Every time they make a decision, you can actually see oil prices weaken even further.
Yes.
Before you see strengthening on whatever it may be. So
I understand the concern that energy investors have, the nausea-inducing volatility that we have to endure. It's a negative aspect of being an energy investor. Thankfully, the returns have more than compensated for that. But you just have to reflect on, why do we own these stocks and what do they sell? Is the demand for that product going to be in long-term demand for the next 15, 20 years, et cetera? There's scarcity. We have U.S. shale production, again, flatlining. We have OPEC, the will and intent of certain individuals within OPEC, we think, wants to lower volatility and eventually get a more budget-friendly price. We have global oil inventories at their lowest levels in history. And if there's any weakness, it's not showing up. We just had U.S. inventories came out this morning, and the deficit to normal levels widened. So the deficit is getting wider, not narrower. If things were so terrible and demand is in the crapper, you see the deficit narrowing, and we're just not seeing that today.
Let's talk about what you're doing in the portfolio then, because you've got, small cap, but even like a CNQ is down about 18%. Are you adding or just enduring?
We're rebalancing because flows are flat, which is great. Like, people are not panicking. My client base is not panicking. What we're doing is we're focusing the portfolio in our higher conviction names, our highest conviction names. We're liquidating or trimming.
Which are what? High conviction?
So in generalities, without talking, because we're active as we speak. So I just bought 500,000 shares of an oil sand producer, mid-cap oil sand producer this morning. Why did we buy it? At $70 oil, it's trading at an 11% free cash flow yield. Any day, they're going to pivot towards giving all of that free cash flow back to us, mainly in the form of buybacks. So at the current oil price, which I think reflects the entire planet believing that we're going into a global recession, fundamentals are terrible, and all these different things, they can still buy back 11% of their shares outstanding, and they have 35 years of stay flat inventory at a minimum. And so we keep thinking, where do we want to have capital deployed? Even at $70 oil, the free cash flow being generated from these businesses is still very, very compelling. Balance sheets are incredibly strong. In many cases, they're either debt-free or they've got one turn of debt. And so even if I'm wrong short term on how low and how long we stay there, these businesses can endure it. And I'm getting decades and decades worth of inventory.
But then you also said you're liquidating some positions.
Well, we're rebalancing.
You're rebalancing? Well, I think you used the word liquidating.
Our less conviction names.
Okay, which would be?
Well, just smaller ones. I can't say. We're active right now. But,
okay.
But it's more what you want to own. You want to own companies with long life inventories. And this is boringly consistent. People have heard this a million times, and the stocks have done really, really well up until 2 weeks ago. So you want to buy companies with decades worth of inventory, extremely strong balance sheets. They've hit their final debt targets, and now they're going to give us all of that free cash flow. And whether it's going to be 14%, 16% at $80 oil, whether it's 11% at 70, it's still extraordinarily compelling relative to whatever you can get in any other sub-index in the TSX or anywhere in the United States.
You can tell me to buzz off, but one of the names Baytex?
Oh, no, we're not. We have not sold at Baytex at all.
All right, because the viewers, they always want to know.
They always want to, everyone owns Baytex. Okay.